Gold and silver are in absolute free fall right now. Not slowly drifting downward, not pulling back in some orderly fashion, not consolidating after a rally. This is a complete and total collapse happening in real time. As I am recording these words, gold just shattered through the 4,600 level. Silver is sitting at $72, and every single time I refresh my screen, every few minutes, the numbers get lower. 4550, then 4520, then lower still. This is not stopping. This is not pausing for breath. This is not a normal market correction anymore. This is a crash that is unfolding while you are watching this video, while you are reading these words, while you are trying to make sense of what is happening to your portfolio. Friday was supposed to be the worst of it. Everyone thought Friday was the capitulation moment. Silver dropped 38% in a single trading session. Gold fell 16%. The worst single-day decline in 45 years. Traders, analysts, experts, everyone assumed that was the bottom. Everyone believed the selling was exhausted, that the panic was over, that the worst was behind us. They were wrong, dead wrong. This is not a bottom. This is pure liquidation playing out across global markets. Forced selling cascading through the system like dominoes falling one after another. Margin calls triggering more margin calls. Traders being completely wiped out, position by position, account by account. And it is not slowing down, it is accelerating. The speed is increasing, not decreasing. The pressure is building, not releasing. Welcome to the hidden economy. If you are new to this channel, I am here to expose what is really happening in financial markets while everyone else is distracted by the surface-level headlines and the mainstream narrative. Subscribe right now because this is the kind of deep analysis and real market intelligence you will not find anywhere else. And if you find value in what I am about to show you, smash that like button because it helps the algorithm push this critical information to more people who desperately need to see it. Now, if you watched my previous video, I showed you the exact level where silver would crash from. I pointed to 117 as the critical technical level. But at that time, people were commenting things like, "Look, it is going up to 118 to 120, you were wrong." Those comments did not age well. Before I show you the data that explains everything, let me tell you what happened this morning when markets opened. Thousands of traders attempted to sell their silver ETFs. They clicked the sell button. Their orders were rejected. Circuit breaker triggered. Friday's crash was so severe, so violent, so extreme that today's prices are still below the circuit limit thresholds. The exchange will not accept sell orders. Think about what that means. People who held their positions through the weekend, hoping to exit Monday morning, hoping to cut their losses and move on, are now completely trapped. They cannot sell at any price, not at a loss, not at break-even, not at any number. The system will literally not let them exit. The infrastructure of the market has locked the doors. This is happening right now, at this exact moment, as gold crashes through 4,500 and silver plunges through 72. This video will explain exactly why this is happening and how to make absolutely sure it does not happen to you. Here is what caused this catastrophe. The weapon being used against traders is called a margin hike. When you trade futures contracts, you do not need to put up the full value of the contract. You put down a deposit, a security deposit, usually around 10% of the total contract value. So if you want to control $100,000 worth of silver, you only need to put down $10,000 in cash. That $10,000 is your margin, your skin in the game, your collateral. If the exchange decides to raise margin requirements overnight, suddenly you need more cash in your account. Not next week when you can transfer funds. Not when your paycheck clears. Immediately, right now. If you do not have the additional cash sitting in your account ready to go, your position gets liquidated automatically. The exchange sells you out, closes your position, dumps your contracts at whatever price exists at that moment in time. And when everyone is getting liquidated at the exact same moment, when thousands of traders are being forced to sell simultaneously, the price at that moment is absolutely terrible. Rock bottom. The worst possible exit price imaginable. One margin hike is survivable. Most experienced traders keep some buffer cash, some reserves sitting on the side specifically for this kind of situation. But what if there are 2 margin hikes in quick succession? What if there are 3, 4? What if, and this is the reality we are living in right now, what if there are 8 margin hikes executed over the course of just 8 weeks? That is not survivable for most traders. That is not a normal market operation. That is systematic extermination of long positions. That is exactly what the CME, the Chicago Mercantile Exchange, has done. 8 margin hikes across 8 weeks, each one specifically designed to drain more cash from traders holding long positions, each one tightening the noose just a little bit more. Throughout December and January, they hit traders with hike after hike after hike. Christmas Day, when markets were closed and traders were with their families, margin hike announcement. New Year's weekend, another hike. Every single time traders managed to catch their breath, to stabilize their positions, to feel like maybe they could survive this, another hike would come. Then came the kill shot, the final devastating blow. January 13th. The CME switched to percentage-based margin calculations. Now when silver prices rise, your margin requirement rises automatically along with it. A trap that tightens itself without any human intervention needed. The higher silver climbs, the more cash you need sitting in your account, even if you do absolutely nothing, even if you do not add to your position, even if you just sit there and watch. And they did not stop after Friday's massacre. Monday morning, another margin hike, then another one this week, 8 hikes total in 8 weeks. For comparison, for context, the entire year of 2024 had 2 margin hikes. The entire year. 2023 had 3 hikes across 12 months. 2022 had 2. 7 total margin hikes across 3 full years was considered normal market operations. 8 hikes in 8 weeks has never happened before in the history of these markets. I personally went through 20 years of CME historical data. This is completely unprecedented. This has no historical parallel. Each margin hike triggers forced selling as traders who cannot meet the new requirements get liquidated. That forced selling pushes prices down. Lower prices trigger margin calls on other traders who were not even affected by the original hike, but now find themselves underwater because prices dropped. Those traders get liquidated, creating more forced selling, pushing prices even lower, triggering more margin calls on even more traders. A death spiral by design. A feedback loop of destruction. That death spiral is exactly what you are watching unfold right now in real time. Gold at 4,500, silver at 72, and both still falling as I speak these words. But here is the part that kept me awake last night, staring at my screens, trying to make sense of the pattern. This morning, the same exact day as the CME announced another margin hike, the Shanghai Gold Exchange also raised their margin requirements, from 20% to 26%. The CME operates in Chicago. Shanghai operates in China, 14 time zones apart, 2 completely different regulatory jurisdictions. America and China agree on absolutely nothing right now. Trade wars, sanctions, technology restrictions. They argue at every single international meeting. They cannot coordinate on anything. But on silver margin requirements, suddenly they are moving in perfect lockstep, on the same day, taking the same action, in the same direction. That is not supposed to happen. That does not happen by coincidence. That does not happen unless both exchanges, both governments, both regulatory systems are terrified of the exact same thing. And I think I know exactly what they are scared of. The number is 356 to 1. That is the ratio of paper silver to physical silver sitting in COMEX warehouses. For every single ounce of actual real metal sitting in a vault somewhere, there are 356 ounces of paper claims, paper contracts, paper promises saying that silver exists. 1 real ounce. 356 paper claims on that same ounce. This system works perfectly fine when everyone settles their contracts in cash. When traders close their positions before delivery, take their profit or loss in dollars, and move on to the next trade, the system functions smoothly. But when people start demanding physical delivery, when they say, "I do not want cash, I want the actual metal," the mathematics explode. The fraud becomes visible. And people are demanding physical delivery right now in unprecedented numbers. During the third week of January, 33 million ounces of silver physically walked out of COMEX warehouses, not traded on paper, not transferred between accounts, physically removed, loaded onto armored trucks, driven away, gone from the system entirely. That represents 26% of everything they had in their vaults disappearing in a single week. 4 years ago, COMEX warehouses held 430 million ounces of silver. Today they hold 113 million. That means 74% has vanished, and the pace is accelerating dramatically. The first week of January, 7 million ounces left the system. The third week of January, 33 million ounces. The exit is not orderly. This is a stampede toward the exits. Who is taking this silver? This is not retail investors buying coins and bars. Moving 33 million ounces requires serious logistics, industrial-scale logistics, armored trucks, security teams, warehouse facilities, insurance. This is institutional money. This is manufacturers who need silver for production. This is sovereign wealth funds. This is smart money, big money, connected money. And they are systematically draining the vaults before March arrives. Here is why March matters. And this is absolutely critical to understanding what comes next. March futures contracts represent 528 million ounces of promised delivery. That is the total amount of silver that has been contractually promised to traders currently holding March delivery contracts. The COMEX vault system currently contains 113 million ounces of physical silver. Read those two numbers again slowly. 528 million ounces promised, 113 million ounces actually available in the vaults. They have made promises for almost 5 times more silver than physically exists in the entire COMEX warehouse system. First notice day is March 27th. That is the date when every single trader holding a March contract must declare their intentions, cash settlement or physical delivery. If just 22% of contract holders demand physical delivery, the vaults are completely empty. Not stressed, not tight. Empty, 0 silver remaining. What happens when the 23rd person shows up with their contract demanding their silver? What happens when the system cannot deliver what it promised? This is the absolute nightmare scenario that both the CME and Shanghai are desperately trying to prevent. This is why we are seeing coordinated margin hikes designed to terrorize long positions into closing before delivery demands expose the entire fraudulent structure of the paper-silver market. And the strategy is working. Look at the prices right now. Gold 4,500, silver 72. Long positions are being systematically exterminated. Traders are being shaken out, scared out, forced out. But here is the smoking gun evidence that tells you this is not a legitimate market crash based on fundamentals. This is manufactured. This is artificial. Pull up 2 prices right now while you're reading this. COMEX silver futures, the paper price. The price you see on CNBC and Bloomberg, $72 right now and falling every few minutes. Now look up Shanghai silver prices. The physical delivery price. The price where actual metal changes hands between buyers and sellers, $100. Let me repeat that because I need you to fully understand how insane this divergence is. The same metal on the same day on the same planet, trading for $72 in New York and $100 in Shanghai. A $28 difference. That is 39% higher for physical metal than paper contracts. If silver was really only worth $72, if that was the true market clearing price, why would anyone pay $100 in Shanghai? Why would sophisticated Chinese buyers, industrial manufacturers who need this metal for actual production, pay 39% more than they have to? They would not. They absolutely would not unless they know something that the paper market is not reflecting. They know the paper price is fake. They know $72 is a manipulated, artificially suppressed number. They know the real value of physical silver is much closer to what they are actually paying, which is $100. And here is what should really blow your mind. The gap between paper and physical is not closing. It is not narrowing. Friday, the gap was $25. Monday, it widened to $30. Today, right now, even as COMEX crashes harder and faster, the gap is still sitting at $28. Shanghai is not crashing along with New York. Physical metal is holding its value while paper collapses. Think carefully about what that means. If this was a genuine crash driven by actual supply and demand fundamentals, by real economic factors, both markets would be falling together. Paper and physical would move in lockstep as they normally do. They are not. Paper is in absolute freefall. Physical is holding relatively steady. That tells you everything you need to know about what is real and what is manipulation. One of these prices is a lie. One of these markets is reflecting reality, and one is being artificially manipulated. And I think you know which is which. Here is who benefits from that lie, who profits from this chaos. J.P. Morgan holds the largest concentrated silver short position of any bank in the history of commodity markets. They have been short silver for over a decade. Every single dollar that silver drops, they make hundreds of millions of dollars in profit. Bank of America carries massive short positions. HSBC carries massive short positions. These banks sit on CME advisory committees. They have direct visibility into trader positioning data. They know exactly where the pain points are, where the stop losses are clustered, where the margin thresholds break. Friday, while regular retail traders lost 38% of their account value, these banks made billions. Today, as gold crashes through 4,500 and silver plunges through 72, they are making billions more. I am not alleging crimes here. Short selling is perfectly legal. Serving on exchange committees is legal. What I am pointing out is the simple fact that the entities who profit most from this crash are the exact same entities with the most influence over exchange policy and margin requirements. You can draw your own conclusions about whether that represents a conflict of interest. The timing of last week's events also matters enormously. Thursday evening, Reuters published a story claiming the U.S. government was ending support for strategic metals programs. Anonymous sources. No official confirmation. Algorithms read the headline and triggered immediate selling. Positions cascaded. Stops got hit. 3 hours later, the Department of Energy issued an official statement. Quote, "The article is false and relies on sources that are misinformed or deliberately misleading." End quote. Completely false. Totally made up. But markets had already crashed. Algorithms do not reverse course when corrections get published. The damage was done. Also on Thursday night, news leaked that Kevin Warsh was being nominated as the next Federal Reserve Chairman. Warsh is known as extremely hawkish, negative for precious metals. Official announcement came Friday morning, but insiders knew Thursday night and positioned accordingly. Fake news articles, leaked nominations, 8 margin hikes in 8 weeks. All happening in the exact same time window. Coincidence? And here is something I discovered this morning that absolutely nobody in mainstream financial media is reporting. The day before the crash, on Thursday, There was highly unusual options activity on silver ETFs. Massive put buying. Huge bets that silver would collapse, placed just hours before it actually did collapse. Either someone got extraordinarily lucky with perfect timing, or someone knew exactly what was coming. Now here is what happened to traders who tried to exit their positions. They could not. In China, the UBS SDIC Silver Fund was completely halted. Not slowed down, not restricted. Completely halted for the entire trading session. 0 trades executed. No buying allowed, no selling allowed, nothing. Imagine watching silver crash 30% and being completely unable to sell your position. Clicking the sell button over and over. Nothing happens. Refreshing the page. Still nothing. Calling customer service. Hold music. Meanwhile, watching your net worth evaporate minute by minute while the exit door is locked shut from the outside. That is exactly what happened to thousands of Chinese retail investors. In the United States, ProShares Ultra Silver, a leveraged ETF, dropped 62% in a single session. If you had $100,000 in that fund Thursday night, you woke up Friday evening with $38,000. 62% of your money gone in one day. iShares Silver Trust dropped 31%, the worst single day in the fund's entire history since creation. But the price drops were not even the worst part of the nightmare. Traders tried to sell. Orders were rejected. Platforms displayed error messages. Systems showed as overloaded. Customer service phone lines had wait times exceeding 2 hours. And when you finally got through to a human being, they told you there was nothing they could do. The system was frozen. Orders could not be processed. One trader sent me a message saying he tried to close his silver futures position for 18 consecutive hours. Every single order rejected. Watching his account drain dollar by dollar, thousand by thousand, with absolutely zero ability to stop the bleeding. As of last night, some traders were still reporting account access issues. Multiple days later, still unable to see their account balances, still unable to execute any trades, still completely locked out of their own money. They crashed the price first, then they blocked all the exits. Then they raised margin requirements again while people were trapped. Think carefully about that sequence of events. Crash the price, lock the exits, raise margins. If you were deliberately designing a system to destroy retail long positions and transfer maximum wealth from small traders to large institutional short sellers, this is precisely how you would engineer it. Now here is the fundamental supply and demand picture that makes this crash even more insane and disconnected from reality. This crash makes absolutely no sense from a fundamentals perspective. None whatsoever. Silver has been running a supply deficit for 5 consecutive years. More silver is being consumed every single year than is being mined. Solar panels need silver. Electric vehicles need silver. AI chips and data centers need silver. Every single iPhone needs silver. Industrial demand is exploding across every sector while mine supply remains essentially flat. The cumulative supply shortfall since 2019 totals 1.3 billion ounces. That represents 18 months of total global production that has been consumed and is simply gone forever. And then China made everything exponentially worse. January 1, 2026, silver was officially added to China's strategic materials list. Export licenses now required for any silver leaving the country. Application processing times measured in months. Volumes immediately down 40%. China refined 65% of all silver consumed globally. They just told the Western world to find another supplier. There is no other supplier at this scale. This is a fundamental supply shock that should be driving prices higher, not lower. And it is not just traders getting hurt by this crash. Real businesses around the world are being destroyed. In Rajkot, India, the jewelry trading hub, 44 firms have declared bankruptcy in just the last 7 days. $425 million in total losses. Families who have been in the silver trade for 4 generations, completely wiped out. In London, 2 hedge funds have suspended redemptions. They physically cannot give investors their money back because their silver positions are so far underwater and they cannot sell without triggering even more losses. In Dubai, physical silver premiums have spiked to 15% over spot price. Dealers cannot source enough metal to meet customer demand. This crash is creating wreckage across the entire global financial system, and we are only a few days into this crisis. Now, connect all the dots. 5-year supply deficit, exploding industrial demand, China restricting exports, and somehow the price is crashing. That only makes sense in one scenario. Paper contracts are being deliberately manipulated downward before March delivery demands expose the fractional reserve nature of the entire system. I believe physical will win eventually. I believe it always wins in the long run. Paper promises can be printed infinitely. Physical metal cannot. But right now, in this moment, paper is winning. Gold at 4,500, silver at 72, long positions being systematically destroyed. So what happens next? Where does this crash finally end? Nobody can tell you with certainty exactly where the bottom forms. Anyone claiming they know precisely is lying to you. I am not going to give you specific price targets because in a crash like this, technical targets become meaningless. Support levels that should absolutely hold are breaking like glass. What I can tell you is what to watch for. Not specific price levels, but something far more important. The warning signs that tell you whether this situation is ending or getting worse. Here is what makes me believe this is not the end of the story. Shanghai premium is not collapsing along with paper prices. Physical buyers are still paying $100 while paper trades at 72. If this was a genuine crash driven by fundamental factors, physical would be crashing too. It is not. Physical is holding value. That tells you everything about what is real and what is artificial manipulation. Silver lease rates are currently at 10%, 20 times higher than normal. Institutions are desperate for physical metal. You do not pay 10% annual interest to borrow something you believe is about to get cheaper. You pay 10% because you need it right now and you cannot find it anywhere at any price. Vault drainage continues unabated. Smart money is still taking physical delivery in massive size. 33 million ounces last week, probably more this week based on preliminary data. While retail traders panic and sell, institutions are backing up armored trucks and removing metal from the system permanently. March open interest remains elevated. Despite the crash, despite the margin hikes, despite the margin calls, despite everything, traders are still holding March delivery positions. They still want physical metal. They have not given up. The fundamental supply deficit has not changed one bit. The shortage is still real. China is still restricting exports. Industrial demand is still growing every single day. What has changed is only the paper price. Only the paper price artificially pushed down through 8 coordinated margin hikes and cascading forced liquidation. At some point, paper prices must reconcile with physical reality. They always do eventually. Throughout all of financial history, every single time, physical reality wins. The only question is how much damage occurs first. How many traders get completely wiped out? How low does paper go before the manipulation finally breaks? I think physical wins. I think it always wins. Paper can be printed infinitely at zero cost. Metal cannot. That fundamental truth has held for 5,000 years of human history. But here is what panicking retail traders always miss during crashes like this. Crashes do not destroy wealth. They transfer it. Friday, massive wealth moved from retail traders to institutional short sellers and banks. When this situation eventually reverses, and it will reverse, wealth moves back in the opposite direction. The only question is which side of that transfer you are on when it happens. Paper at 72, physical at 100. That $28 gap closes eventually. Someone profits enormously when it does. Here is exactly what I am watching. These are the specific numbers that will tell you what happens next. The Shanghai Premium, currently at $28. This is the truth teller. This is the gap between what paper contracts say silver is worth and what physical buyers are actually willing to pay. If this gap widens to $40 or more, paper is losing all remaining credibility. If the gap narrows because physical starts dropping to meet paper, then maybe the manipulation thesis is wrong. But if the gap narrows because paper rises to meet physical reality, that is when you know the game is fundamentally changing. This gap tells you everything. COMEX vault levels get released every single Friday. Last week, 33 million ounces walked out. If this week another 20 or 30 million ounces leaves, the vaults will be nearly empty before March delivery period even begins. Who is taking this metal? Where exactly is it going? Why are institutions paying for armored trucks and security and insurance to physically move silver while the paper price is crashing? They know something. They see something coming. Lease rates are currently between 8 and 10%. Normal is 0.5%. This represents what institutions pay to borrow physical silver for short periods. When lease rates spike like this, it means physical metal is extremely hard to find. The last two times lease rates hit these levels were 1980 and 2011. Both times, something very big happened in silver markets shortly after. March open interest tells you how many contracts remain open for March delivery. If traders are capitulating and closing positions in panic, open interest drops rapidly. If traders are holding despite the pain, despite the margin calls, open interest stays elevated. High open interest going into first notice day means delivery pressure. That is exactly what the exchanges are desperately trying to avoid. Trading halts, platform freezes, account lockouts. If more funds get halted, if more platforms freeze, if more traders report being locked out of their accounts, that tells you the system is under serious stress. Functioning markets do not freeze. Healthy markets do not lock people out. Stressed markets do. Shanghai Premium, vault levels, lease rates, March open interest, system stress indicators. Track all of these closely. The data tells you what is actually happening before anyone else figures it out. Shanghai Premium widening means paper is losing credibility. Lease rates spiking means institutions cannot find physical metal anywhere. Trading platforms freezing means the infrastructure is breaking under pressure. These are not just random numbers. They are warning lights on the dashboard. Here is what I need you to understand about what you are watching right now. This crash is not random market volatility. It is not normal profit-taking after a rally. It is not just natural price discovery. 8 margin hikes in 8 weeks, unprecedented in market history. CME and Shanghai coordinating on the exact same day, enemies moving together. Unusual options activity the day before the crash, someone definitely knew. A $28 gap between paper and physical, a divergence that should not exist in an efficient market. Vaults draining at 26% per week, smart money running for physical. Thousands of traders locked out of accounts, unable to exit positions. 44 firms bankrupt in India overnight. Hedge funds freezing redemptions. Physical premiums spiking globally while paper crashes. This is not a correction. This is a coordinated attack on long positions specifically designed to shake them out before March delivery demands expose the fractional reserve nature of COMEX. The attack is working. Long positions are being destroyed right now at this exact moment. Gold 4,500, silver 72, and still falling. But the fundamentals have not changed one bit. The shortage is real. The deficit is real. Physical is trading at 100 while paper trades at 72. At some point, this ends. Paper reconciles with physical. It always does throughout history. The question is whether you personally survive until that moment arrives, whether you can hold through the pain, whether your stop losses already got hit, whether margin calls forced you out, whether your position sizing was appropriate for this level of volatility. That trader who messaged me Sunday night, he did not survive. He was right about everything, right about the fundamentals, right about the shortage, right about the manipulation, and he still got completely destroyed because he could not meet the margin calls. Ask yourself tonight very honestly, do I truly understand my exposure? Do I have a realistic exit plan? Is my position sized for survival, or am I one margin call away from losing everything I have? The winners in markets like this are never the ones who predict perfectly. They are the ones who survive, who manage risk properly, who stay calm while everyone else panics, who have cash reserves, who do not use maximum leverage, survive until clarity emerges, then act decisively. This is not financial advice. I am not telling you what to do with your money, your decisions, your responsibility. But if you are watching gold crash through 4,500 and silver collapse through 72, you absolutely need to understand what you are actually looking at. You need to see the complete picture. The margin hikes, the coordination between exchanges, the physical versus paper divergence, the vault drainage, the March delivery pressure. That is what this analysis has given you. The complete picture that nobody else is showing you. Gold at 4,500, silver at 72, Shanghai at 100. The gap is screaming. Paper and physical cannot stay this far apart forever. When that gap finally closes, someone will have bought at the absolute bottom. Someone will have held through unbearable pain. Someone will have seen what everyone else missed. That could be you. Or you could be the trader who messaged me Sunday night with his account completely wiped out. The difference between those outcomes is not luck. It is risk management. It is position sizing. It is having a plan before the crisis hits. Drop your thoughts about this crash in the comments. Share this with someone who needs to see it. Subscribe, because I'm covering this situation daily until something breaks. The data updates every day. The story develops every hour. I will be here explaining what it means. See you in the next one.